Most investors jump into the market, but never take the time to verbalize their objectives. Markets can be unpredictable, so no stated objectives prevents you from both judging your success and improving your skills. What you believe is possible may be unrealistic or overly conservative, but once you verbalize, at least you can determine how to best improve yourself if you're not reaching your goals. The important variables to consider include your return objectives, your risk tolerance, and your time commitment. I'm often asked how much you can make when you're actively investing in the marketplace. Well, let's take a look at Stanley Druckenmiller, one of the greatest of all time. He returns on average 30% a year, but he did that for 30 years. Now, if you take the math and you compound 30% over 30 years, you'll see how incredible the number that really is. Another example is William O'Neill, who turned $5,000 into $200,000 in only 2 years when he first started out. That's a 40-fold move, or 4,000% return in only 2 years. And myself, in 2020 in the US Investing Championship, I had a 346% return. Now, returns are really a function of your effort, your experience, your risk levels, and the market environment. It really directly ties in with what kind of risk you're willing to take, what your time commitment is, and what your turnover and holding periods are. 100% is very possible. But if you can't accept a 5% drawdown, or you only want to spend 1 hour a week working at this, I wouldn't say it's very likely. So this is why it's so important that you determine what is most important to you. You really need to balance that equation between risk, reward, and effort, and no one can really do that for you. And so at the end of the day, just trying to judge one trader or one investor versus another in terms of determining what you can make is really not the best way to look at things, because you really want to have to balance out all of these different factors. So for one person who's more conservative, maybe they don't want 100% return a year. They only want 25% return a year, but they want a very small drawdown in the process. Some other people, myself included, especially when I first started out as a teenager, risk was almost not even part of the equation. I just wanted to make as much money as possible. And trust me, the volatility of returns were there to confirm that. But that was my place in life at that time. That's what I was looking for. And you just really need to take a step back and look introspectively and determine what your goals really are. One crucial element, though, I want you to consider when you do this is the asymmetry of losses. In almost all cases, outsized returns do not justify deep drawdown or excessive risk. Let's take a look at the following graph. As you can see, the deeper the loss, the bigger gain that's required to come back to even. Eventually, you're going to be wrong, and excessive risk is just absolutely detrimental to your system. If you have a 75% drawdown, you need a 300% return to come back. And trust me, it's possible. When I started out and I had crazy risk levels and I was just doing whatever I could to make as much money as possible, I had huge advances in short periods of time, and I had the drawdowns to come along with that. So it's just really important that you realize that deep drawdowns are just so counterproductive to advancing your account. Once you start breaking that 20% drawdown, it just gets exponentially more difficult to really come back and advance again. And the more time that takes, the more opportunity costs that you miss out on. So you really, as much as possible, even if it means making a little less money, you want to focus on controlling your drawdown. And for myself specifically, I think drawdown is probably one of the best tools to use when managing risk, because it looks at your account as a whole and it really impacts what kind of gains you need to make back your losses. So it's just so important. When you consider the different objectives, another key element that you want to consider is the kind of system you're going to want to operate off of. So most of the popular styles include trend following, swing trading, day trading. I would say fundamental analysis is a form of trend following. You're trying to find an undervalued company and ride that for a period of time. I know the active growth investor program we're working with, although there's short-term entries, it's really the fundamentals of it is a trend following approach. However, the amount of time you're spending in positions, so really trend following versus swing trading and day trading, really changes the amount of turnover you're going to have and your win percentage. Most people don't really even know where to turn to or what the differences are between the styles and what to expect. Really all methods can be successful. I myself have used variations of all of these different styles over the years, and I've made them work. And the underlying formula that you need for success is consistent between all of these different methods. Now, if you look at the best investors of all time, Warren Buffett, William O'Neill, Paul Tudor Jones, They all have really dramatically different investing styles, yet they're all successful. But the underpinnings of what's required to have that profit at the end is consistent between all strategies. So there's 5 key variables that really determine the amount of profit you're going to make. Your win percentage, the amount of money you make when you're right, your win size, your loss percentage, the amount of money you lose when you're wrong, so your loss size, and your turnover. Typically, your win percentage and your win size are inversely correlated. So by that I mean, if you want to have really large wins versus your losses, you're probably not going to be right as often. So, I mean, the perfect system would be that you have huge gains and you're right most of the time. But in reality, trend following systems tend to have larger win sizes. And as a result, there are many times where there's trends that don't develop and you have small losses, so your win percentage is lower. So a lot of this goes back to what kind of a business you want to run. I mean, can you withstand being wrong 7 out of 10 times, even if you're making money? I know I can, but it's frustrating. If you're someone who, again, wants to be right rather than make money, it's going to be very difficult to apply a strategy that way. And there's really a fine line between, having a high win percentage and a low win size. So for example, a casino can be, right very often. They're going to have the majority of 50% of the time. But when they're right, they only make a little bit more than when they're wrong. So in the market, that's somewhat more difficult because the game is not controlled by you. So you don't really know for certain over time how right you're going to be, or how many times you're going to be right versus how many times you're going to be wrong. I think it's important that we take a second here and we look at trend following versus swing trading and versus day trading and get a sense of what your returns are likely to look like and how resilient each style is. Here we're going to review some of the most popular strategies, and we're going to get a sense of what it's like to work and live with them. We're going to review all the variables, and we're going to see how each strategy has different levels of turnover, profitability, and resilience. And this will help you decide which of the strategies are really right for you. So we're going to begin our analysis by looking at trend following versus swing trading. Day trading is a little bit more of a unique business, so we're going to look at that next on its own. But in all of these examples, we're going to keep some variables consistent, and that will be that the account size is $100,000 and our average trade size is $25,000. Now, in the case for trend following, trends don't occur every day. So we're going to assume that we're taking about 40 trades a year, which works out to about 3 or 4 trades a month. But when you catch a trend, they pay. So our gains will be 4 times bigger than our losses. So you can see that here where our average win size will be 3% return on the account, and our average loss size will be 0.75% of a loss on the account. So really your win size is 4 times larger than your loss. For swing trading, we're going to assume 250 trades a year, which is about 1 per day. You're fairly more active in the market when you're swing trading. You're always looking for market opportunities. However, the quality of those trades do start to diminish, and you're not always going to have blockbuster trades like when you catch a great trend. For that reason, we're going to assume that our wins are only 2 times larger than our losses, and that's fairly consistent with swing trading. And you can see here that our average win size is 1.5% return on the account, and our average loss size is 0.75% return on the account. To begin with, I want to look at how both of these systems with these assumptions work at a win rate of about 40%. Now, in some very good markets, you're going to have win percentages that are 50, 60, or 70%, but that's really rare, and that's not typical over long periods of time in the market, especially with a trend following approach and also somewhat with swing trading. And so you can see here with a 40% win rate, you have about a 30% return on the account when applying the trend following technique, which is about $30,000 return. For swing trading, because you have greater turnover in this example here, you are able to have a larger return at 37.5%, or about $37,500 return. However, what I really want to point out is how a small difference in your win percentage, so if you drop that win percentage to only 30%, so you walk into a more difficult market environment and you're only right 3 times out of 10, and trust me, in choppy markets, it can get worse than that. A trend following approach, as a result of having your gains substantially larger than your losses, you're still able to eke out a 15% return on the year, whereas in a swing trading approach, that really starts to impact the bottom line and you're sitting with a loss. And this is why a lot of people who start to use swing trading techniques in a bull market feel very confident, but as soon as a choppy market comes around, they start to really cut their account up, and it can get really bad really quickly. In fact, we're not actually factoring in here a more realistic example. If you catch some of these losing trades in a large losing streak, the returns could be even a lot more negative than just a 19% return. And that's probably a discussion for another day, as that can get really deep into statistics, but you want to keep that in mind. And if you further reduce the win percentage to 20%, and trust me, I've traded at that kind of a win percentage in certain market conditions. I mean, markets can get tough. With the trend following approach, if you stay persistent over time, you can still break even in a year with 40 trades if even only 20% of those are profitable, if they're large enough compared to your losers. And the ability to break even with a very poor win rate of 20%, really builds that failure into your system. Again, surviving is mission critical, so you really want to be able to survive poor market environments. That's really where most traders do get in trouble. You'll see that with a swing trading approach, because you have so much turnover, that reduction in win percentage is absolutely critical and really hurts your performance with a 75% loss. And really, this is why most traders do blow out in the market. They hit a period of time where they're trading too aggressively or just have too many losers in a row, and their wins are just not big enough to offset their losses, and they slowly bleed their account. So again, it's not that one strategy is better than the other. It really depends on what part of the spectrum you want to sit. If you're someone who wants to be very, very active and be trading very often, and that excitement is part of the business that you're running in addition to making profit, you do want to focus on swing trading. I mean, that does allow you to be very active in the market. And if you're good, there are some traders who are excellent swing traders, and their win percentage does stay above 40% for long periods of time. They're going to have great returns. However, that does take a lot of experience and skill. And most people new to the market or only somewhat experienced have a hard time pulling off a win percentage greater than 50% over extended periods of time. With trend following, what I think is better for trend following versus swing trading is that you really build failure into the system. And you can be wrong, but you can still survive. As well, if you don't want to be sitting in front of that screen all day, every day, or you want to concentrate more your position in your stocks, trend following has less churn. It allows you to be a little more concentrated and doesn't keep you so attached to the screen. So there's really pros and cons to each of these strategies. I just want you to be aware of what they are and how they would handle in different market environments. Again, this is a very simplistic overview because we're not factoring in losing streaks, winning streaks, and different money management tools where your position size will change over time. This is really just to point out what it's like to live with these different systems and how resilient they are under different market scenarios. Here I want to discuss day trading, and this is probably the most misunderstood of all investing styles. And I day traded for a number of years when I started out in my career as a professional. And you are really trading much more than if you're swing trading or trend following. Here in this example, I assume 10,000 trades a year or 45 trades a day, and that may sound crazy to a lot of people, but that's definitely what I was doing, if not even more. So we're going to view some of the same variables, but with a much higher trade count. And what's different about day trading is that really your gains and losses are about the same size. So I really assume that you're making about 1/4% return of the account with each trade and 1/4% loss. However, you're right just a little bit more than you are wrong. So you're right 55% of the time, and you're wrong 45% of the time. And I'd say this is really the casino model. This is like you running the casino, and you're not going to have these major wins when you're right. You're going to be right just a little more often than you are wrong, but you're going to consistently apply that edge. However, unlike a casino, you don't control the entire game. So you don't have that certainty of outcome after many trades. So any small variation in win percentage can be detrimental. However, if you look at this simple example, thanks to turnover, this small win size with only a 55% win rate allows you to have a 250% return on your account, which is substantial and substantially more than the other trade styles we looked at. And the reason is that you're turning over your edge many more times than you are with the other types of investing styles. However, any kind of variation in win percentage is really detrimental to the system. I mean, in this case here, just a small 10% miss in win percentage where you're right only 45% of the time more than wipes you out with a 250% profit loss. I mean, it's absolutely detrimental. So you have to have a strong edge, and you have to keep that edge and apply it over time. Whenever that edge erodes slightly, you have to really adapt. And that's really what took place when I was a professional trader. That when I started, there were no algorithms. And when those algos came into the market, that's really what kicked out a lot of professional traders in the world that I worked in. Now, I was able to successfully trade for many years with the algos. And one of the reasons that I decided to move on was really a matter of also lifestyle. It was getting kind of exhausting to be in front of the screen all day and having 200 orders open at any time and not being able to blink. So I think after about 10 years of doing that, I wanted to change up the way I live my day-to-day life. But another factor that day trading has that I would consider a negative is that your impact on the liquidity is much more pronounced. If you're in and out of stocks, the liquidity on the stocks that you're trading is all the more important. The spread between bids and offers, you're trading in and out so many times that you really need to take that into account. And as a result, if you want to keep growing your account and you want to keep becoming a better and better trader, eventually liquidity will be a limiting factor, and that's what I ran into. I know some people may be quick to say like you can just trade stocks that are more liquid or bigger, but the edge I was applying was really on smaller cap and low liquidity stocks. So the fact that they were low liquidity was how I derived my edge. And as a result, I was kind of capped as to where I could grow. And that's one of the reasons why I switched strategies. So, day trading is really a unique animal altogether, and it has its own kind of ecosystem compared to other styles. But if you can get that edge and you can apply it well, it's a fantastic approach because you go home at night with virtually no overnight risk. Your drawdowns in your account are usually very minimal as you're just applying that edge over and over again. And really, my friend and I that we used to trade with all the time always said it's the perfect system because you're making this money and it's almost kind of like a cash register or like you're running that casino. However, if that edge erodes at all, you're in big trouble. So there's really the pros and cons to each system. And I really feel that the variables I presented to you are a fair representation of what it's like to live with each of these systems. And it really depends on what kind of business you want to run. That's what these different systems represent. They're different styles of business. And my personal preference is to run a trend following system because I can concentrate further. I don't have to be attached to the screen. And when I'm right, I can have a major impact on my account. And I really like to work in a world where I'm trying to understand the business and what the potential is for that business over time. It's a little more intellectually stimulating. However, it really comes down to what you're looking for. But the majority of this course will be based on a trend following approach, and we're actually going to use some swing trading techniques. So it's kind of a hybrid between the two, but the results are really more fairly represented by trend following statistics. Again, the stats can be better than what I'm showing here, but I think for anyone to apply these strategies with a greater win percentage, it really comes down to the skill of the operator and them being able to use their edge that they've developed over time, something that's a little more unique. If you're going to be just using kind of an out-of-the-box strategy that you learned about in a book, it's going to be very unlikely that you're going to be delivering 70% win percentage with a swing trading technique. It really comes down to experience and how good a trader you are and understanding changing dynamics in the marketplace. So before you really jump in with your capital and you spend all of your time devoting yourself to one of these types of strategies, I think it's best that you sit down and really think about all the variables we discussed, the time commitment, the number of trades and turnover, the win percentage that's acceptable that you can survive with, and really build that into your business plan, and you really stop and think about what kind of business you want to be applying. As you're starting to see, high performance trading is a deep subject, and most people really jump in with no knowledge of any of this. Would you start a business that way? No. You'd sit down and you build a business plan. I've supplied you with a strategy development document that can be downloaded. I suggest that you fill it out now to the best of your ability. When you get to the end of the course, you'll be able to see how dramatically your approach to the market has changed. You'll be able to notice what you were missing and how you've changed what you were doing. At the same time, at the end of this course, you'll see how I approach the market. I'll give you my version of the same document that you can cross-reference and then take a little bit of what I've provided or keep what you've built over time that's really customized to how you want to approach this market. You should really understand every element of your strategy, and we're going to go into detail as to why each piece of this strategy is important and how you can change or adapt each tool to reach your goals specifically. It's going to allow you to improve what isn't working, and most of my plateaus occurred when I didn't articulate all of my techniques. So my aim is to have this document guide you and help you become a better investor over time as you continually update it and really make it as the basis of how you approach the business of investing. As Mike Tyson says, everyone has a plan until they're punched in the face. This document will be your focal point. It'll be your guiding light in difficult times because trust me, that market punch is coming and you'll have to adapt and you'll have to adjust and get yourself back on plan. In the next section, we're going to explore the principles that are the foundation of the active growth investing strategy. So let's dive in.